So to put it mildly, we've had a pretty eventful last few days economically that regardless of where you are on the political spectrum, I'm pretty sure we can all agree has been a little tumultuous and confusing, but I thought I'd take a minute to share some thoughts from a real estate point of view on why all this chaos might be good if you are looking to buy or sell a home anytime in the not too distant future. So this is not financial advice, entertainment purposes only, do your own research, etc. That all being said, so in most cases, economic instability means lower interest rates on mortgages, COVID being a very extreme and recent example of this. So, why does this happen? It happens because mortgage rates are tied to the 10-year treasury bond. So, one of the things that stock markets value more than anything is macroeconomic stability. If you're investing your money in, let's just say, General Motors, you want to know that GM has a firm understanding of how much their inputs are going to cost, who their customers are going to be, how they transport their products, a million other parts of whatever makes their business go. And when something disrupts that, like say, I don't know, indiscriminate tariffs on all of our allies and biggest trading partners, investors in stocks don't like that, not one bit, right? It's just too many variables to try to predict. So the economic break glass in case of emergency is to sell those stocks and buy treasury bonds because at least so far, treasury bonds are seen as a less risky safe haven to wait out the storm of whatever has them spooked on the equity side. Okay. So all this money pouring into treasuries, including and in this case, especially the 10-year treasury, makes the price of those bonds go up. When the price of a bond goes up, the yield or the interest rate that the bond is paying decreases relative to the price of the bond. So bond prices and the interest rate that the bond is paying always have an inverse relationship. Makes sense so far? So the yield on the 10-year treasury going down results in a similar decrease in mortgage rates. And indeed, in the last few days, this is what we've seen. Not huge shifts, but meaningful enough to move the market and result in huge increases of loan originations. So that's the finance lesson. But what does this really all mean? What can we expect going forward? It means that love them or hate them, as long as the entire fate of the world economy and geopolitical stability hinges on the whims of a single person who seems to live for chaos and himself doesn't seem super sure of where this is all heading or what the point of any of this really is, the one thing we can probably safely bet on is a continuing sense of uncertainty and fear in the markets. And this isn't even mentioning the almost certain bubble that we're in the middle of with the stock market in general, which has been grossly overvalued for years, but that's a whole different topic to get into. And it means that if you're in a position where you're shielded from some of the negative consequences of an uncertain economy, like you have job security, good credit, savings, etc., this could be one of the best times to buy or sell real estate that we've seen in at least the last 2 or 3 years, but it's also going to be very competitive. So, in my opinion, there's going to be some rapidly moving price discovery happening in the next few weeks to few months as rates probably come down and demand floods the market faster than supply can likely keep up with. Comps that sold just a couple months ago could already be irrelevant. Market dynamics are going to be changing dramatically on a weekly and even daily basis. And it means that it's going to be highly recommended that you work with someone who is super tuned into this stuff and understands the intricacies of what's going on and is able to look at and understand metrics that nobody else is even thinking about looking at. Maybe someone who has a background as a Series 7 licensed financial advisor and specializes in investment properties, but can just as easily apply that knowledge to primary residences. Maybe somebody like that, if you know of anybody like that. But in any case, I hope this helped at least somebody out there a little bit. And if you have any questions or concerns or anything, just shout out. Let me know. Jake Lyons with that properties in Chicago here, by the way.